this video, we're going to specifically be chatting about one REIT that I'm kind of interested in buying. That is Simon Property Group, ticker symbol SPG. This is something that I started picking up maybe like a month ago, slowly adding to the portfolio. I honestly, I don't think I've really done my due diligence on the stock, but I have obviously been looking into it. But yeah, in this video we're gonna be kind of going through one of the 10 Qs. This came out August 3rd. I guess that's when they had earnings. I'm just gonna try and learn a little bit more about the company, and I figured, I might as well make a little video and share it with everybody because I'm gonna read this anyway. The thing that interests me the most about this company, it's just the valuation as well as the consistency of, I guess, just how long this company's been around too, and they've managed to go through even the recession of 2008. Obviously COVID, but it's also like the management and how they're, I guess, tackling the challenges and stuff. I think they're being smart and about it. So anyway, the evaluation I think is great. Even Seeking Alpha is giving a B plus valuation. They're very profitable too, according to Seeking Alpha Analytics. They got no growth, I guess, but I don't know about that. We'll see. Dividend yield right now is a 6.5%. I think that's quite nice, and they are rapidly increasing it. They just announced, I think it was, they raised dividend 2.5% to 7.27%. Which it was like, this is on top of another dividend increase they had a few quarters ago. So they've been increasing it every half year. One thing though, okay, so actually before I go to that, the PE is not how you really value these things. It's the price to the funds for operation. So that is about under 10, which is pretty low. So yeah, this is another. The valuation I think is just really attractive. The dividend yield is there, and I think that it's a tough market though right now because interest rates are so high. That is something that we need to take into consideration. They do have, actually, that's one thing I want to check. They do have a decent amount of debt, I believe. Let's go to quarterly, sure. How much debt do they have? Liabilities, long-term debt, 24. Let's say 25 billion. Okay, that is quite a lot of debt. How much free cash? Actually, I guess, how do we do this? What's the best way? Again, I am not an expert at analyzing these companies or REITs specifically. But I'm just gonna try and do my best. Net income they're making, let's say 500, maybe, 500, let's call million when they have 24 billion in debt. Now that's obviously not because it's a REIT. Again, they have so many write-offs and like tax advantageable things. So cash from operations is actually 1.1 billion, maybe like 900. We'll call it a billion just to keep it kind of conservative. Cash from financing, net change. Where are we going? Free cash flow per share. Been hovering it around like $2, 2.5. Free cash flow levered is about, let's say, 500 to 600. I guess no matter how we're looking at it like that, yeah, they have a lot of debt. That's one thing that I'm kind of tired of doing is buying companies that have a lot of debt that also pay a dividend. I just don't like it, but we make exceptions here and there because this is specifically a REIT. I'm expecting them to have a good amount of debt. But if we go to the dividends, they have the dividend safety rating as a D+, but that's because they also cut it during COVID for I think a quarter or two. But what's the dividend history? Let's go to that. They cut it for 1 quarter, and they've slowly been getting it back up. It's almost back at $2 where it was pre-COVID. So 190 pre-COVID was $2.10. in short, I think the valuation is very attractive. The dividend yield is quite high, but again, the interest rates, if they persist, it's gonna be hard on this company. But I think that's kind of part of the risk, obviously. Let's dive a little bit into their 10Q. I have nothing really planned for this. We're just gonna kind of wing it and kind of pick up things that I kind of that I'm interested in learning more about. Okay, so management discussion of analysis of financial condition and results of operation. That's one thing we want to see. Risk factors, default on a mindset, disclosures. So do we really care about? I want to hear more words. I don't want to see numbers. So let's actually go to item 2. So sign property, management discussion, blah, 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 blah. Is a Delaware corporation that operates as a self-administered, self-managed real estate investment trust under the revenue, blah, blah, blah. And more stuff I don't necessarily care about. Okay, we own, develop, and manage premier shopping, dining, entertainment, and mixed-use destinations which consist primarily of malls. Premier outlets in the mills. As of June, we have owned or held interest in 196 income-producing properties in the U.S., which consist of 93 malls, 69 premier outlets, 14 mills, and 6 lifestyle centers. Okay, operated 37 states and Puerto Rico. They have 80% non-controlling interest in some other realty group. Interest in 24 regional, super regional outlet malls. Okay. In addition, we have redeveloped an expansion project, including restaurants in North America, blah, blah, blah. As of June 30, 2023, we also own 22.4% equity in something else another publicly traded company, Paris-based real estate company, which owns or is interested in shopping centers located in 14 countries. So they do own so Simon Property does own at least 2 other companies, or REITs specifically. Yeah, we also own retail. They own JCPenney, or I think a percentage of it. Spark Group, intellectual property and licensing revenue, some other companies. So, real quick, one thing they did during COVID was they pretty much bought out JCPenney because they were going out of debt, and JCPenney had obviously a pretty big presence in Simon Property malls. Now, is that a smart thing by Simon Property? I'd say the best situation is JCPenney doesn't default and they can pay their dues, but that was not the case. So I think the next best thing was for Simon Property just to buy another company like JCPenney that is operating in their stores and keep the company alive, I guess. Again, it kind of depends how you see it, but I think that was kind of a smarter decision. We generate the majority of our lease income from retail tenants, including considerations received from fixed minimum lease consideration, fixed common area, reimbursements, and variable. Okay, that doesn't really mean too much to me. Revenues for a management company after intercompany eliminations consist primarily of management fees, are typically based upon revenues of the property being managed. Yes, I think management fees include property being managed. We invest in real estate properties to maximize total financial return, which includes both operating cash flows and capital appreciation. We seek growth in earnings funds from operations, or FFO, and cash flows by enhancing the profitability and operation of our properties and investments. We seek to accomplish this growth through the following: attracting and retaining high-quality tenants and utilizing economics of scale to reduce operating expenses, expanding and re-tenanting existing highly productive locations at competitive retail rental rates. I'm not gonna go through, I guess, all of this, but yeah. We also grow. Okay, blah 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 blah. Establishing properties as leading market research providers, retail, other business and consumer focused corporation, offering service for tenants and others, including waste handling and facility services. strategy, provide the capital necessary to fund growth, maintain sufficient flexibility, access capital in many forms, both public and private, including but not limited to having the place operating. The operating partnership's $5 billion unsecured revolving credit facility. Okay, blah 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 blah. We consider FFO, net income, or NO, net operating income, NOI, and portfolio NOI to be the key measures of operating performance that are not specifically defined by. Yeah, okay, that's just covering their butts. Okay, this is the results. I'm not gonna say. I want to hear more. I guess we gotta go into the 10Q maybe for this. But here we go. Make sure I'm not missing anything. United States portfolio data. The portfolio data consists in this overview includes the following key operating statistics: the ending occupancy, average base minimum rent per square foot. We include acquired properties in the data beginning the year of acquisition or move disposal. Okay, okay, so here we have a table. There's no title to the table though. Percentages. What is this? U.S. malls and premier outlets. There's the title. So this is a 1-year change. The total portfolio ending occupancy is up 80. I guess is that right? Basically 8.8%. I guess is the better way to look at it. I don't like these basis points. That's 0.8%. Average base minimum rent per square foot is up 3%. I feel like it would be more. I'm just thinking how much rents went up, but average base minimum rent per square foot. What's the difference between total portfolio ending occupancy? How is this different? Average base minimum rent per square foot. Consolidated, unconsolidated total, ending occupancy. Okay. Oh, this is US TRG, and this is, I think, just everything. What's TRG? Did they say that? Total something revenue. I don't know. Anyway, I don't think that ending occupancy is a percentage of gross leasable area, or GLA, gross leasable area, which is leased as one. The last day of the reporting period, we include all company owned. Okay, so obviously they still have like 5% occupancy that's not occupied. 5% non-occupancy, so that we obviously want 100%, but I think 95 isn't terrible. Actually, I guess it'd be good to see like a total year over year of that. Results of operation. Let's see what else they got going on here. Liquidity and capital resources. Okay, this might be good because we own long-lived income-producing assets. Our financial strategy relies primarily on long-term fixed rate debt. Floating rate debt comprised 2% of our consolidated debt. Okay, we also entered into interest rate protection agreements from time to time to manage interest rate risk we drive. Okay, so that is kind of. I hope that these, I guess, bonds or the debt that they. That's one thing we should really look at. When's the debt expiring? If their debt's expiring like in a year, and rates are still as high, that's gonna be kind of bad, because that means they're gonna have to take on so much, or they're gonna be paying so much more each year just in interest on that debt. Actually, I think we gotta go to their 10Q to see that. But anyway, the total 2.1 billion in aggregated. Wait, what are we doing here? We derive most of our liquidity from positive net cash flow from operations and distributions of capital from unconsolidated entities. I'm tired, guys. That total 2.1 billion in the aggregated balance of cash and cash equivalents was $250 million in the first 6 months. Went to $830 million. So okay. Remember though that they have like $24 billion in debt, but so like the cash on hand, I feel like isn't that important though, because you want it to be in the assets as opposed to cash. I mean, cash always does present buying opportunities, but anyway. The rated average interest rate was 4% for the 6 months end. Okay, that's great to know. The 6 month end, the max rate. Okay, weighted average interest rate. How much are they paying in interest? Financials. Do we go to the balance cash flow? There's a balance sheet. Liabilities. They have no current debt though, basically none. Okay, I think we gotta go to... Yeah, how much are they paying in long-term debt? That's cash, or I'm just gonna check, I'm pretty sure it's cash flow, but I just wanna check this. Net interest expense. That's not it. No, it represents interest paying on any borrowings, bonds, loans, convertible debt. That actually might be it. So it's like maybe it's 200 million a quarter. No, this is a year. Why did I put quarterly though? I'm confused. Oh, it is quarterly. I'm just dumb. So maybe 200. Let's check the balance sheet or the cash flow. It would be in investing or financing. Total debt repaid. I don't think that's it though. It should say interest. Why can't I find it? Am I dumb? Insurance. I controlled F interest and nothing popped up. I don't know what I'm missing. Oh, I just spelled interest wrong. S. I don't think it's minority interest though. This is one reason why I do like to use Yahoo Finance. I just feel like I know where everything is. Total interest expense, net interest expense. I guess that's it. Minority interest. Anyway, I'm sorry, I don't try to. Real quick, just because I like Yahoo Finance, sometimes we have, where'd it go? Net insurance payments. So I think this is how much they're paying each quarter. So about 280. Wow, they had a lot to pay here, but about 280. Oh wait, that's really 12 months old. Where are you again? Here we go. Each quarter maybe. Why is that positive? That should not be positive. Net insurance payments of debt. Anyway, let's call it like 200. Like, is it 200 million a quarter? Probably. Okay. Anyway, let's go down cash flow. Wait, our business model requires to regulate access to debt markets to raise funds for acquisition. It makes sense. I mean, also, yeah, they're just probably saying they can dilute the shares. That is a question too. How much do they dilute the shares? Let's do annually. Shares. And here we go. Total shares. The outstanding shares. 2013, 310. And they got 320. So maybe 17 million shares. Which is actually like, for a REIT, is not a lot. Actually, if we check out like, check this out. Like, let's go to shares. Look how many shares. They went from 207 to 700, and especially the last 2 quarters or 2 years, they went from 360 to $700. That's massive. And I mean, the stock price did jump up a lot, but I mean, they probably have a little bit less debt. It's just something to keep in mind, though. Like, yeah, that's how they raise the money, but it depends. Would you prefer as an investor? Cash flow or net cash operating activities, distribution capital from unconsolidated. 2.1 billion for the 6-month and 2.1 billion addition. We had net repayments of debt for blah 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 of 43 million. Okay. Actually, I want to go to the financing and debt section. Financing and debt, sweet unsecured debt. I don't really know the difference, to be honest, of unsecured and secured debt. Okay. I'm trying to scan this or just something. Okay. Mortgage debt. Okay, let's just start scanning a little bit more. Here we go. Summary of financing. Okay, something I can digest. Our consolidated debt adjusted to reflect outstanding derivative instruments and the effective weighted average interest rate of June 30, 2023 and December 31, 2022. Okay. So we have the fixed rate. In fact, the variable rate is up to 6%. Jeez. It is considerably a lot less. So they have 24 billion numbers in thousands. 24 billion fixed rate at 3.5, about 3.5. The variable rate, which is about $500,000, that's 6%. Jeez, that's gonna. How does that work? Effective weighted average rate includes the impact of net discounts and debt. Because if you have that and you got that, there's no way that this number should be less than this, but it's because of, I guess, this, which I don't, to be honest, understand. But interest rate, adjusted balance, is that because they're paying it off? Hold on, this is a little bit more intense than I thought. So we have the effective weighted average interest rate, and we have effective weighted average interest rate. This is as of June. Okay, so this is the newest. Okay, so it went from 3.22 basically to that. So the variable rate must be their shorter term bonds and stuff. Not entirely sure, but if I had to guess, but the thing that I don't get is, how is this? This should be like a lot higher. This should be like maybe 3.8% or something like that. Maybe we could do the math, but anyway. In terms of long-term debt arrangements, the following table summarizes the material. Okay. Long-term debt. They're anticipating. What are we looking at here? Long-term debt represents maturity, principal maturities only, and therefore excludes net discount. Okay. So, okay, oh, perfect. So 2023, they're looking at about 500 million in debt repayments, 1.5 billion in, interest payments. Why so much? Variable rate interest payments are estimated. Okay. I'm just trying to think if I wonder if they're projecting. Let's see if they have anything. Acquisition. No, I don't want to get too sidetracked. I want to find. Oh, what was it already? Oh, actually, this might be a good section. Forward-looking statements, perfect. That's actually exactly what I wanted. Okay, we don't need any of that. No, I want to see it. Oh, do they have any? Here are their risks and stuff. Do they have an outlook, though? Risk factors, yeah, we know. There's risks. Do they have an out? So nowhere on this page do they have an outlook, which is, I mean, it's not like that helpful, but it's kind of nice to see where they think their company's stands. Any bad legal proceedings? Okay. We have. I don't get it. Where are they? We have recorded liability when a loss is concerned. Okay, risk factors. They have to have some legal proceedings. I guess they just don't have it on here. Oh, maybe here. Maybe not. I don't think that's it. I wonder if they're doing buybacks. Okay, let's go back to this screen a little bit. What do we want to look at? There's so much. I mean, we could obviously look at this, but I need something to read. Some people do give some good analysis, but maybe people are gonna buy this person has to sell it as of July. Not as safe as the recession spreads. I wonder. Let's see the summary of what this person said. Simon Property Group premium retail not as safe as the recession spreads. News commerce property markets experience a decline in valuation due to record interest rates. That is true. With the commercial property price index down over 60%. Okay, yeah, that's true. But I'm kind of expecting these valuations to be pretty good for at least a little bit because, again, these markets are getting hit and they should be. And if there's a lot more fear baked into it, that's when these things get really appetizing from a valuation point of view because there's obviously the more risk associated with it. But I mean, a REIT, the basic dividend like over 6%, I think is quite impressive. So you guys gotta pick your battles, and for the cash flow portfolio, it's hard to debate these. Or not debate. It's hard to not want to add at least some of this to the portfolio if the valuation's there. Retail REITs are seeing a significant performance bifurcation, okay, with companies like Simon Property performing most REITs with the retail sector. So Simon Property is, keep in mind, up almost 30% in the last couple months, which is kind of annoying. Where do we go? I want to go to the chart. I kind of wish I just bought a little when I was at $100. If it was $100, the yield would be over 7%, but that's why I'm only picking up some here and there. The retail sector is facing challenges due to a slowdown in real retail sales, rising operating costs, and changing consumer habits, which could lead to further decline in property valuations. Sure. As an higher income bracket faces disproportionately higher real wage and loss and unemployment growth, period retail spending may fall faster, particularly with student loan repayments due. If capitalization rates continue to rise to meet parity with commercial mortgages, expectation property may fall to 40% from its current level. 40%. I mean, if it falls 40%, I would be buying. I don't want to go on a whole different topic, but Verizon is a good example of a stock that dropped a lot, where it's it's different though. The yield is good, but they just have so much debt, and those interest payments they're repaying on the debt is crazy. They do have some bonds expiring very soon, early 2024, I think, if I remember correctly. I looked at it a little while ago. Not very good. I don't want to be. Yeah, but this REIT is a little bit better at managing that, I guess, or they're not. I gotta pick my words carefully because I haven't obviously done super intense research, and I'll just end that there. But if Simon Property fell in valuation 40%, I would buy 100. Or for me personally, I'm not saying anyone else should. I'm just saying for me, I would pick some shares up. Like a stock like Verizon, even Walgreens falling that much, it's different because the valuation might be better or more attractive, but the stock itself, I think, is suffering for other reasons. Let's read and see this person a couple days ago, the comeback dividend. Let's see their highlights. The Simon Property Group dividend is recovering from its dividend cut, but it's not impacted. Okay, it's almost there though. Simon Property Group has a high debt rating and its diversification is superior location helped it bounce back better than competitors. owners. Dividend yield is high and the payout ratio is historically low. This is a great bargain combination for investors. Dividend increases are expected to continue. I mean, I wouldn't be too optimistic, but I would think so, actually. Quality investments have usually high appreciating potential. Trade investments, okay, I'm a long player. If I get oil, I mean, this just, again, this seems like kind of hypey. It just seems, yeah, there's no, like, I don't want to rip on this person, but it doesn't seem like there's any value in this summary. This is just like, it's going to be great. Let's see one more. Continues to have strong buying opportunities. Sure, let's check out this guy. This person, largest REITs, market cap in the air 40 billion. The company has generated strong financial results, revenue of 1.7 billion. The most recent quarter net income of 560 million. Portfolio includes premium properties that perform well despite the value investor. Okay. Let's go to some property real quick. Like, look at this. Let's go to the last month. Month is good, maybe not. 6 months. So back in May, even March, you could have picked this up for like $100, and that would have been a 7.5% yield. And I started picking some up. I think it's 116, 117. It's maybe 1% of the portfolio, but if it gets down to this $100, I'm gonna be very happy. Above a 7% yield, I think is nice for, like, again, just a REIT dividend. I'm definitely gonna be cautious though, because I'm tired of buying companies with a lot of debt that also pay dividends, because I would rather have a company like Snap-on or just buy an ETF where it's a lot safer for, yeah. I'm just leaving it at that. I understand the risks and stuff, but it's just sometimes it's just like, oh my gosh, this is so appetizing. But I'm hoping this gets back to $100. It'd be very, very nice. I'd be happy buying there. Oh man, I'm tired. I know there's some other companies like and there's other REITs out there. Is paying almost a 3.5% yield. That actually went up a lot the last, like, maybe is down in the last month, like 6%. Maybe even a little more. I mean, yeah, there's like good things about this company, but like, again, they're diluting the stock a lot. Yeah, I don't know. I'd rather just buy silent property, and if we like see some of the top ranking ones, I would want to go buy profitability. Yeah, like, let's see, I don't even know any of these. Let's go buy dividend. No, I thought that was a tab up here. I don't know what KRG is, but if a REIT is yielding 3%, I'm just not interested. I'm sorry. Wait, what does that say? 4.6% dividend. Oh, that was back in June. Then we go to REG. 4%. Okay, not terrible, but like, the thing is with the REIT, if it's a REIT has to be, in my portfolio, or in my opinion, for me, if it is not yielding a couple percentage points above what a bond is currently yielding, or substantially above what like an ETF, a dividend ETF is yielding, why am I gonna buy that? Because the REITs have a lot more risks. Not a lot more risks, but in this current environment with all the interest rates, it's a higher risk. And the fact that it'll never be a qualified dividend makes the taxes on it so much higher. So it's just all these little things to take into consideration. Now that reminds me, I was off tangent. Does Las Vegas Sands have a dividend back yet? They do. Wow, interesting. Interesting. Okay. This is a casino. Yeah, I forgot about that. Anyway, I'm gonna wrap this video up. I don't know if I learned enough about the company, but I learned more than what I knew before. I did plan on making this like a video where I like print out the paper and stuff, but I'm not printing out like 100 pages of stuff. So anyway, though, we'll do some pen and paper stuff soon because I prefer that. I think it's just better content. Thanks for watching, everybody. Let me know if you own silent property or anticipating on buying it for whatever reasons, because I'm trying to find reasons to buy it and to not buy it. But I think it just